Moneycontrol and Aditya Birla Sun Life Mutual Fund present Sahi hai Pathshala.
Globally, passive investing is picking up pace, and the situation in India is no different. The high cost and underperformance of large cap funds has made investors lap up passive funds, and the numbers really say it all. Assets under management of index funds increased by 2.68 times to 1.33 lakh crores in January 2023 compared to last year. Now, given the gaining popularity of passive funds, today on Sahi hai Pathshala, in collaboration with Aditya Birla Sun Life Mutual Fund, we talk about passive funds. Hello and welcome. I'm your host Surabhi Upadhyay, and joining me today on the show is Abhishek Singhal, Head of Passives and Alternate Strategy at Aditya Birla Sun Life Mutual Fund. Abhishek, thanks very much for joining in. I think this is a great subject to touch upon because these funds are really beginning to gain a lot of traction. But we're going to keep it very, very simple and start with the basics. Explain to us the difference in the approach itself. There's this passive approach to investing, there's the active approach. So what really are passive funds and why should we consider them for our portfolio?
Passive funds are very, very simple sort of strategies. They started in US in 70s, but India as usual is a leapfrog nation. We started with active funds. We did not start with passive funds. Passive is something that does not have active human intervention on a day-to-day basis and just simply replicating an underlying index. In doing that, it just basically brings in far more discipline, far more transparency, so to say. And at the same time, it just simply avoids all sorts of human bias because of the fact it does not have human intervention as much as active funds. They come at really low cost as well. So your key benefits are low cost, discipline, simplicity and transparency. And clearly the markets love it. Passive funds already are 18% of the total mutual fund industry AUM. Because of the key difference of transparency, key difference of discipline, today passive funds are available not only in equities. There was a time when it was only a large cap equity or a
simple Nifty 50 fund perhaps.
Today you have debt index funds. You have quantitative strategies, something like smart beta, and some things as simple as maybe even price of gold or silver.
Okay, Abhishek, I think you already have my attention. Very true. There are so many different types of these funds and we've moved beyond the plain vanilla. So explain to us, I mean, there's debt, there is equity, then you spoke about this factor-based smart beta. It gets a little complicated. So do simplify it for us.
There are three kinds of passive funds.
Okay.
ETFs, indexes, and fund of funds. There are three categories of investors as well. There's a category of investors who say, I know it all. I just need the most efficient investment tools. ETFs are basically investment tools for them.
Okay.
These are the cheapest sort of instruments available, somewhere ranging from 5 basis points for a Nifty 50 ETF to something like 35, 40, 50 basis points for a gold ETF or maybe a smart beta ETF like a momentum or a quality. And then you have index funds. Index funds are similar to ETFs. They will track the same underlying index, except they are like mutual fund schemes. As an investor, you are used to giving money to a mutual fund house, taking money back from a mutual fund house. ETFs are traded on the exchange, index funds are not. You just deal with the fund house. And that's the only difference between the two. The third category of investors is ones who say, here's my money, I need a life cycle solution, asset allocation to be done for me, or an access to an international market like NASDAQ or US or something like that. That's where fund of funds come in.
Okay.
They either give you an access to a space where you did not have access, or they create a portfolio for you across asset classes like equities, fixed income, gold, international equities, and manage the churn across these asset classes for you.
Okay.
They save price for you, which is expense ratio. The underlying schemes are cheap. They save the tax cost because every time you buy and sell in your portfolio, you are incurring a tax cost.
Right.
But if the fund of fund is buying or selling for you, you are actually not incurring that cost because FOF is tax free.
Right.
You just hold it from point to point. And as long as you hold it for a longer period of time, it's a very tax efficient solution for you. It cuts risk, it cuts cost, and it gives you a very efficient risk adjusted experience in the market.
What else should one keep in mind while investing in these funds? Are there factors to consider, or are there risks that one should always keep at the back of their mind?
Every mutual fund investor feels confused, and that's where recategorization happened in 1718. How do you choose a mutual fund scheme? And precisely the same thought goes in here as well. What is the appropriateness of a Nifty 50 index fund or a Nifty SDL PSU 2026 fund for you? An investor basically needs to think, what is the investment horizon, what is my investment objective, and what is the kind of risk that I want to undertake. Given these three questions, one has to just simply has to pick up the right index or a bunch of indexes. Now, how does one do that? If you are taking an index fund, typically an advisor can help you do that choice. If you are an active trader and you know your personality, you could pick up an ETF directly. So if let's say I'm a risk averse investor, I'll typically go in for a Nifty 50.
Okay.
But if I'm somewhat of an evolved investor, a little bit engaged, but not an active trader, a momentum ETF or a quality ETF, which buys high momentum companies or high quality companies,
Okay.
it's the right thing for me. They just simply churn the portfolios at their end, basis a quantitative technique, basis the design of that index itself.
Okay.
The fund manager has got nothing to do with it, except ensure that there is efficient trading underlying in that ETF.
Okay. So got it. Basically, understand the technique that the fund follows, see if that matches with your investment objective, your risk appetite, and then take a call and then see if you want to go in for it.
Absolutely.
Okay.
While now picking which index fund or which ETF to do out of, let's say, 200, 300 ETFs or indexes which are already now available, and I think more are on the way, the 2-3 things that an investor needs to look at or an advisor needs to look at are the tracking error of the fund, which is basically how closely does the performance of this particular scheme corresponds to the underlying index,
Okay.
or the expense ratio. Even in a passive fund, while there are differences compared to an active fund, you could see differences across schemes.
Sure. Sure.
Cheaper funds or more expensive kind of funds.
Got it.
See which is a more efficient solution, which is a more, a lesser expensive solution, and go for it.
And now let's talk about returns. Sure, passives are a lot more cost effective versus active funds. But the question is, what about performance over, let's say, longer spans of time? And I'm sure your team has done a lot of research on this, active versus passive. So how does the performance track record really stack up?
So this is a raging debate, I think, for the last 10 plus years. Even 20 years ago, we used to debate whether passive funds will make a landfall in India. And here we are with passive funds already contributing about 18%, all-time high of the total mutual fund AUM. I would bet this will hit 25% in the next 3 years.
Wow.
But having said that, I think there is room for both. Even if you look at the more evolved markets like US, Europe, Japan, anywhere you see in the Western world, both of them coexist. Though there are more monies going to passive schemes in the developed markets, they are more mature. Wherever there is room for alpha, active schemes do have a role to play.
Sure.
But if you look at the recent SPIVA report, up to a 5-year period, majority of the large cap managers, as much as 75%, have underperformed their benchmarks.
I thought of just telling our viewers, in case you're wondering what SPIVA is, it's S&P indices versus active. Basically, it's a study that's conducted in terms of how these passive indices behave versus, let's say, active funds, right?
Yes.
Okay.
So this report is published every 6 months, and it's been done for many, many years now. The thing is that even in a diversified segment, the same sort of percentage is now starting to pan out in terms of active managers underperforming their respective benchmarks.
Okay.
So as markets deepen, the alpha potential starts to erode, and that's where index funds or ETFs start making more and more sense for investors. In spaces like small cap, there is still much room for creating alpha, and investors would probably do well to be with active funds. Hence, one has to look at both spaces while building a portfolio. There are also emerging spaces like commodities, gold, silver, and fixed income, where investors still want to go the traditional way. I'm sure you already know that 90% plus of India's savings are still going to FDs. Debt passives or debt index funds have become a new craze. In the last 1 year or 2 years alone, more than 1 lakh crore has been built up in this space called debt passives.
Okay. So they are sort of evolving products and more interest perhaps coming through. So we need to keep an eye out on that. Lastly, just this whole point of how to build a portfolio. There's always this concept of, the core holding and then the satellite holding. So this core and satellite, do explain that to us and how an investor can go about creating the portfolio.
So as I said earlier, this is an evolving space, and there are spaces where there is room for alpha generation, and there are spaces where there is no room or very little room left for alpha generation. I think from a risk mitigation perspective, active managers have an advantage where they can take cash calls. They can take active calls with respect to stocks or sectors. Go into a defensive position when volatility hits the market.
So actives when there's volatility, perhaps.
Perhaps.
Okay.
But over a longer period of time, investors need to understand what do they want from their portfolios. Do they want risk-adjusted return? Do they just simply want a target return at the end of, let's say, 10 years, 20 years, 30 years? For instance, a retirement plan. They just want 8% to be generated, for instance.
Absolutely.
And no volatility. That's where different sorts of solutions will start coming into play. For instance, a multi-asset category has now become extremely popular over the last maybe about 3 to 5 years, as people have started looking at risk more than the returns that we are traditionally used to. And this is where you can start using passives as a part of the portfolio.
Sure.
In certain segments like large caps, where there is little or no alpha available, clearly there is no choice. You have to buy an index fund. You have to buy a Nifty 50. You have to buy a Nifty Next 50. Maybe even a Nifty 50 equal weight, which are more modern, more quantitative sort of strategies. But in spaces like small cap, in that allocation, you may do well to have a small cap fund manager.
Okay, so keep those strategies in mind, and obviously your objective in mind, and then there are solutions across, I think, across needs. It's been a very, very engaging conversation. Thank you so much for taking out the time and explaining the basics of passive investing to us.
My pleasure, Surabhi. Thank you so much.
That's it on this conversation. Thank you very much for watching.
Moneycontrol and Aditya Birla Sun Life Mutual Fund present Sahi hai Pathshala. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.